Thank you, Carl and Sarah. Welcome to the Halftime Report. I am Courtney Reagan, and today for Scott Wapner, front and center this hour. The committee is making some big moves as this record rally takes a breather. We're breaking down the trades straight ahead. Joining me for the hour, we have Stephanie Link, Bill Baruch, Rob Sechan, and Bryn Talkington. Let's get you a check on the market right now. A little bit under pressure, certainly seeing some more red than we've seen, in the last week or so since the election. We have the NASDAQ composite down about a quarter, so the best of the major three. S&P 500 down about 1/3%, and the Dow Jones Industrial down about 0.6%. Russell also taking a bit on the chin here today, the worst of those major averages. What do you think, Stephanie? Is this sort of a bit of profit taking, a bit of a breather, or is this just sort of a regular healthy market getting used to the fact that we don't have so much uncertainty?
Yeah, well, we were up 5% last week, so there's that. So I think it's just a breather, to be honest. I actually think it is going to, we are going to see the markets resume their strength. Seasonally, November and December are very strong months. You have $6.4 trillion of cash and money market funds, and you have a lot of portfolio managers that are behind their benchmarks year to date, and you only got 2 months left to actually make up for that. And you mentioned we did remove a lot of uncertainty last week, like a lot. Elections, Fed, China stimulus. And you know, Courtney, the market doesn't like uncertainty. So we checked the boxes on all three of these things. Now you're focused on the new administration, pro-growth, deregulation, less government spend, which will be more than offset, I think, by higher business investment spend. And so all of these things are really positive. Of course, we have to watch about tariffs. Of course, we have to watch about a little bit more inflation. But this all comes about when we're at 2.5% GDP growth, and inflation is making a comeback in terms of coming down and making progress. And earnings, which is what I follow, which is what we all follow, because the markets follow earnings, are actually running up about 7% for the past quarter, and revenues up 5%, very healthy. And margins, most importantly in my mind, have been much better than expected. And so you are seeing that operating leverage. So that's why I think people are going to make their shopping list, like I am, and add to on any weakness.
Fair enough. You know, Bill, I think it's interesting this Bank of America Fund Manager Survey was talking about what Stephanie is saying of all of these positive growth factors. At least that's what we think, but then also the possibility of higher inflation. I mean, can you have both? Can you have sort of this record growth going forward that we believe we might have under this new administration, but also potentially higher inflation if we have some more tariffs?
You know, I think that'd be normal to digest. I mean, the inflation has come down significantly over the last year and a half. So there's going to be a higher floor. And I don't think the Fed, going back to Powell last week, they were basically saying they don't want to see inflation below 2%. They wanted to stay running above there. So I think the market participants are going to be used to a little bit of higher floor of inflation. And that's why I think that's going to be normal going forward.
And Rob, you know, it's interesting. Macquarie has a note out today saying stick with quality and growth. And then Wolf Research basically says the opposite. One says go for the Trump trade. The other one says, no, not so much. Go the opposite way. Where should you be putting your money? If you have the chance here today to put some money to work when we have a bit of a pullback.
No question. It's a tiny bit of a pullback. I kind of agree with that, with what everybody's saying. But there's no doubt that when you've had this type of a year, 20+% performance, you get some of that uncertainty removed that, my colleagues here have talked about, that you typically have a strong final 2 months of the year. So the probabilities are in your favor, the trends in your favor. I think it becomes a little bit tougher in 2025 because we're pulling forward some of that price performance. And if you looked at the Trump trade the last time, what you saw is everything that it was working then is working now. But it was fleeting because what ended up happening as we pivoted into 2017, going back a ways, that leadership that we saw early faded and new leaders emerged. It was really the technology leadership that was prevalent then. The other thing that I would say is it was a very different environment back then as well. We had very low CPI. We had earnings that were actually accelerating. And, you started off with interest rates at 1.8%. You started off with valuations on the S&P that were about 16.5 times. And when you have an environment like that, you obviously have more upside. Today, we are in a different place. Interest rates are higher. They're certainly more restrictive, right? Valuations are higher. Yet, when I talk to our client base, and they're some of the titans of industry, there is no doubt that they are feeling much more optimistic. I don't know if it's about the administration. I think for many it is. I think it's the certainty that has come with that, despite the uncertainty around tariffs and some of the things that he could ultimately do.
Back in 2016, the eve of the election until March of 2017, the S&P 500 rallied 15%.
Wow.
And then at the end of 2017, you were up 25%. So that's what we're seeing here, right? It is about the growth. It is about earnings. It is about, you talk about high interest rates. Absolutely, I agree with you. But actually, you're about to embark on a rate cut cycle. It may not be as fast as we want them to cut, but that's actually very positive. There's a reason they say don't fight the Fed. When the Fed is cutting rates, that's very pro-risk on and risk assets.
Let's not forget deregulation. I mean, up and down the government, there's going to be a tailwind behind businesses from the SEC reporting to FTC. I mean, there's going to be a lot of ways that these companies are going to benefit within this new administration, too.
Bryn, I want to get your take in here. Obviously, a lot of things have been said, and I think that Stephanie brings up some good points, and we're looking at sort of the past to help guide us for the future. Macquarie, though, also says today's environment very different than 2016. What clues do you think we should be honing in on? Which ones do you think we should be wary of? And frankly, have we gotten a little bit too far ahead of ourselves? I mean, Trump has not officially taken office yet. We don't actually know what the policies will be. We're just sort of trading on campaign speak at this point.
I think at the index level, the trend is definitely feels like it's going to continue to go higher, and I think that would be foolish to fight that. But underneath at the individual security level and at the certain ETF level, Courtney, there's a tremendous amount of FOMO. And if you look this week, like Dogecoin up 200%, like crypto, like levered MicroStrategy ETF up 50% yesterday. Tesla, which both Bill and I own, up 34% in the last week. And so I feel like if you look in the options market, these zero-day expiration options, there's just so much volume and so much energy on these individual security levels that I think that investors need to be aware of their own FOMO and continue to be disciplined, because I think you're going to get some really big moves at the security level as people are just really speculating and trading. And as we know, individual securities can go much further on the upside or much lower on the downside than they actually should. And I feel like we definitely have that on the upside with some individual names, and especially within certain cryptocurrencies.
I think we're going to drill down more on that in a second, so that's a good tease. But I want to get to Bertha Coombs. She's got some breaking news for us. Bertha, what do you have?
Courtney, the Justice Department and several states' attorneys general are moving to block United Health's $3.3 billion acquisition of Amedisys. This has been reviewed for some time now. Merrick Garland, the district attorney attorney general rather, says we are challenging this merger because home health and hospice patients and their families experiencing some of the most difficult moments of their lives deserve affordable, high quality options. He continues, the Justice Department will not hesitate to check unlawful consolidation and monopolization in the healthcare market that threatens to harm vulnerable patients, their families, and healthcare worker. The Justice Department, of course, has tried to block a United Health merger in the past. Several years ago, they tried to block United Health's acquisition of Change Healthcare, the billing services. That was their rival. They did not prevail in a trial. It remains to be seen whether this will go to trial. And of course, Courtney, we're at a situation where we are going to see a change of administration as this lawsuit is brought. Whether a Trump administration Justice Department would be inclined to proceed with that lawsuit remains to be seen.
Very interesting, the timing, most especially. Bertha Coombs, thank you so much. I want to turn to you quickly, Bill, because you were just talking about deregulation, the potential for maybe more mergers and acquisitions and deals. What do you make of this news here that Bertha just brought us?
I don't have a hard feeling on it. I don't have a horse in the race with United Health. We don't own the name anymore.
Sure.
But I do think it's a wake-up call to what we're seeing right now and under this current administration, what could potentially come here in the coming months as things flip. So
that's probably why the stock is not down that much.
Okay.
Right? Yeah. Most stocks are not down that much because they don't believe it.
Yeah. I haven't seen the reaction, but yeah, that would make a lot of
sense.
Yet another deal here blocked. Well, very interesting. We talked just a moment ago, and I'm going to get back to this point, that one of the biggest winners since the election, excuse me, has been Tesla. Shares pulling back just a bit today, but they're still up nearly, 40% in a week. Bill, you trimmed your position on this yesterday, and why was that?
Yeah, this is just portfolio management. Our model has Tesla weighted at 2.5%. It got to about a 3.5% position and hovering right at our top 5. It's a 40% move over the last week, and really we added added to it going back to August, and we increased it. It's up 80% or so since we increased it. So portfolio management, I don't want it in the top 5, and I think it could take a little bit of a breather here with just the exuberance, and you have to monetize that sometimes.
Got it. And Bryn, you brought it up, so I want to lob this ball to you too. You've got some ownership in Tesla.
Yeah, I think that's a smart move. I mean, I listened to the earnings call. If I take the election and Elon and all of that out of the picture, the fundamental and the story around Tesla is still really strong. But do understand next year they're saying we're going to have the new car. I think it's like the hatchback 3 Series. The company does need to deliver. And so I think this is a great example of a great company with a great founder, great team that gets overextended. I mean, I sell calls against this name. So at this point, I had some calls at $270 that I collected like $17 of premium. So at this point, in January, this portion of my stock would get called away. And so whereas Bill's trimming, I'm selling calls to manage my position.
So another big winner since the election, Bryn, you also brought this one up to crypto, and Bitcoin slightly lower right now, but this is after rallying to nearly $90,000. These moves are just incredible, really. I mean, Rob, when you look at something like this, do you feel like you just got to play this, whether it's a miner, whether it's the currency itself, whether it's an ETF? I mean, what's your strategy here?
So listen, it's definitely been validated, not violated. And there's been a lot of pull forward because of what this administration campaigned on. And while we're not core holders of Bitcoin or Tesla, we have many clients that own these names. And you have to say that they have been absolutely validated by what is happening. There's a general embracing from the regulatory framework that is, saying that these are real investments, real assets, and I don't think you can ignore that for sure. And I would tell you that to those that hold it and those that are big believers, whether it be a Michael Saylor or an Anthony Scaramucci or an Elon Musk, they don't care about the regulatory environment. They were owners anyway, and I think many people in this space feel exactly like that. I personally own some. We don't recommend it for clients. That happens from time to time.
Billy, you're a believer.
I am a believer. I mean, I've personally owned it since 2017, but this year was the first time we incorporated it into client portfolios. And really, it's about sizing it properly. When we did this back in July, we bought IBIT, the ETF, and we did that as a 0.5%, and then we bought Marathon Holdings as a 0.5%. We looked at that as a high beta potential move, and something that could, if we expected Bitcoin to go from 60,000 to 100,000 this year, which is closing in, it's about half of that move so far, we would have expected Marathon Holdings to do 3x. And it's, we're only up about 20% on Marathon Holdings because it's been severely underperforming up to this point. But the way we look at it and what I want to lean on is just how we size things within portfolios and having that crypto exposure and sizing it properly.
And Bryn, you're playing this through an ETF.
Sure, yeah, I own IBIT, also own some Bitcoin individually, but IBIT, and I think that, with the GBTC not becoming a trust, with IBIT, the low fees, the institutionalization of Bitcoin, especially with IBIT, that's capturing the majority assets, coupled with the deregulation and a much friendlier SEC next year, I think institutions are going to be feeling much more comfortable about making this part of their allocation. And so I still think there's lots of tailwinds. That being said, when Coinbase, and I love Brian Armstrong, but when Coinbase, is up 60% in 5 days, that's a big move. And so that's where I'm telling investors, just beware of that FOMO, because you've just had these outsized moves in some of these individual names. And history tells you these names are going to digest and pull back.
Yeah, absolutely. I mean, it's obviously getting an awful lot of attention because of these moves. The committee also, though, making some other big moves in tech. We talked a little bit about this before when it comes to the Trump trade. So, Bill, you bought some more Microsoft and Amazon. Why now? Why those names specifically?
Yeah, I mean, first with Microsoft, first of all, this is cash that came from Tesla. We had a little extra cash on the sidelines, so we've been underweight Microsoft, and we wanted to get it back to weight. So we're adding to Microsoft. Going back to the earnings report, it wasn't a bad earnings report. It was a good earnings report. It was really the guidance that really brought the stock down after hours. And I think they're potentially lowering the bar. If you take a look at Azure, their cloud is growing at 33%. I mean, there is tremendous growth, and that beat expectations. So I'm really excited from the underperformance standpoint. It's going back to February of 2023 that is underperforming the NASDAQ to that level. So I think there's a lot of opportunity for upside, and I think we'll close that gap over the coming months. As for Amazon, it's simply hopefully it's breaking out. They had a behemoth earnings report recent weeks, so I was waiting for this, seeing this solidify that breakout. Their margins grew 40% on the report. That is amazing. So I think there's a lot of upside here, and they've unlocked the profitability within AWS. They did $10 billion in revenue. It's up 50% from last year.
Is Amazon your favorite way to play the cloud?
It has to be. It's one of our top 3 plays right now, under top 3 holdings next to NVIDIA and Alphabet. I think Amazon, this breakout here, after failing to do so middle of the year, this is some pent-up energy that really has tremendous upside.
I think it was the best quarter of the Mag 7.
Yeah.
By far. And you mentioned profitability, but it was across the board. It was in your world, North America retail, which actually grew 100 basis points year over year, and then international 300 basis points, and then AWS, as you mentioned, 780 basis points, 38.1%. That is huge, and they got a lot of operating leverage as a result. And I don't know what they're going to do with their cash, but $48 billion in cash, something has to happen here. Either pick up that buyback or announce a dividend or something, because that's huge, and that's going to grow to $68 billion next year. So I agree with you 100%. It's one of my largest positions.
I want to hang with you, Stephanie, because you also sold some Apple, so we're not playing in these names, but sticking on tech. What's your move there?
Well, I bought a lot in May, and it's up about 40% since then. When I bought it, it was at 26 times forward. It's now at 35 times forward. I'm just not sure the iPhone 16 is going to be that super cycle that everyone expects. I think 17 and 18 will be, absolutely. I just don't think we're going to see it right away. And I just think when you have revenue growth growing at about 6%, earnings are down 30%, what are you willing to pay for that? So I'm just looking for maybe like a pullback in the name to get back into it. But I made a lot of money, and I'm just taking that and put it into Amazon, actually.
I don't disagree. It's showing signs of exhaustion, Apple, right now. We own it, still in our top 5. I'm a little more upbeat on this cycle. There's a lot of people who own the 14 that are not going to get that Apple Intelligence, and that upgrade cycle is one of their largest. So I think there's a big tailwind that could be there. However, I don't disagree with you, and I think there's some exhaustion. The market, the stock, the performance is telling us that right now.
Let's move on. Let's move on to Meta. Value Act taking $1 billion stake there. I mean, is that going to add to the volatility? Rob, what do you make of this? You're an owner.
We are an owner, and it's our largest overweight in the portfolio. We haven't sold a single share since we bought it in late 22. You can tell the way we run money just by looking at the names we own here. We're overweight Meta, we're overweight Google, both low PE names. We're neutral Apple and Microsoft because we feel like they've hit relatively a PE ceiling, and you're going to need to see some of the things that Bill just outlined for them to perform from here. We've owned them a long time. It's very tough for us to trade in and out of those because of the impact on clients. And we're underweight NVIDIA, although we bought it on the most recent dip when it dropped to 30 times PE. Now that it's 40, we're not chasing it. And sadly, we do not own Amazon, although we'd like to. We used to. We'd like to. And Tesla's just too expensive for us, despite how I feel about the man and the business that they're in. So Meta, from our lens, is by far the best way to continue to play the monetization of AI. They saw tremendous strength in their advertising revenue, and it fed through to the kind of rest of the business.
Bill, Meta and Alphabet reiterated by MoffettNathanson saying the company saying that market continues to undervalue the long-term core earnings power of these two companies, and you also are an owner of Meta.
Yeah, we own Meta, and I think Rob, you definitely highlighted the advertising tools that they provide. I mean, you're seeing a lot of momentum behind that. I mean, they're really implementing AI. The one, obviously, the elephant in the room is the CapEx spending, and that was something that's going to continue to be there. So, if they ever really kind of, right that ship, I mean, there's going to be tremendous upside.
Bill, what's funny there, though, is that's why they got hit years ago, because they were spending too much. They weren't managing costs. They got that act together. Now they're very enthusiastic about the prospects, and I think markets are more accepting about investment today than they may have been when they were investing in the metaverse. So I really think it's a different time.
There's a difference between AI and the metaverse, right?
Yeah.
It's an AI arms race. If you're not spending, you're going to fall behind.
Right. Correct.
Remember when the metaverse was all the rage? Oh, man.
For like a minute.
I know, exactly. And now it's all about AI. Well, Steph, I want to talk about CrowdStrike because you're getting involved there.
Yeah, so I never owned it before, and when the stock fell 40% after the Microsoft glitch, it fell, and I thought, wow, this is the #1 company in the cybersecurity industry, which I am hugely bullish on between now and the end of the decade.
It's kind of hard not to be, isn't
right?
it?
I think cybersecurity is bigger than AI. I really do. I think it's going to be well north of $1 trillion in spend. If you talk to the CTOs at any company, they're saying they're spending on two things: AI because they're trying to figure it out, and cybersecurity because they can't wake up and lose their business overnight. And so CrowdStrike, #1 player, #1 management team, #1 products and platform, and their retention in the past quarter, even after the Microsoft glitch, is 98%. So you're growing earnings 40%, revenues 30%, and a lot of the other metrics really very, very healthy. So it's still down about 15% from its highs. So that's why I just continue to add after I sold some of the Apple and put it into Amazon, and just kind of maneuvering my technology positions.
Yeah, picking up some of that opportunity. Yeah. I know, Bill, that you also own CrowdStrike, but I want to get to Bryn. Bryn, obviously I'm going to give you a little bit of a jump ball here with tech. What do you make of the move? CrowdStrike, you want to talk about Meta, where do you want to go with this?
Yeah, I own Bug, which is the ETF, which, I think Steph is spot on about the spend for cybersecurity and AI, that the spend for cybersecurity, this is a secular issue. And I think that spend is going to be consistent and it's going to be high. So I'm owning it via the ETF Bug, but I love Steph's move into CrowdStrike. I think this is just a space of growth. You can have consistency, like people with Apple. Own Apple because it has a durable balance sheet that continues to grow. And I think people will continue to allocate to this space because the CAGR is just going to continue to be in the double digits for the foreseeable future.
Rob, you own Fortinet, and that's hitting a record high here today.
Indeed, but if you would have talked to me back in July, I would have been a very sad person because
timing is everything.
It was actually down for the year. This is an example where patience has paid off. That was the relative value play versus Palo Alto and CrowdStrike. If you look at the multiples on those names, they're 82, 61. And Fortinet trades at 41 times earnings. They're hardly giving it away, but if you're going to play that secular theme, we like to play it on a value basis and have finally been rewarded for some of the positive things that are happening with this team.
Fortinet up 41% over the last 3 months. Okay, let's talk about IBM. Stephanie, you bought more of this. Why?
Yeah, because the stock is down about 9% from when they reported about a month ago. And I thought the quarter was actually quite good. This is a company that is really in a transformation in terms of finding growth and getting away from their legacy mainframe businesses. And their growth is coming from software and part of consulting and part of services. But software was up about 10%. Red Hat was up 14% in the quarter. It reaccelerated, which is very exciting. Not surprising, but we've been waiting for that for the last couple of quarters. And then, of course, Gen AI, they have exposure. It's now a $3 billion business for them. It was only a $1 billion business last quarter. That's a huge growth for them. And the free cash flow guidance of $12 billion plus. They have a lot of flexibility in what they can do. And this CEO has just absolutely delivered on what he said he was going to do. Make this more of a growth company. It's not hyper growth, but it's growing more than it ever has. And I think as they do more and more M&A going forward with the cash that they have, I think they'll continue to grow.
I'm going to give you the last word, Rob, before we move on here.
What an opportunity set for IBM. If you've looked at it over the last few months, it's actually outperformed the tech sector. This is a name where software and cloud infrastructure are going to be huge assets going forward for them. And I think this is a name that's a turnaround story, and people are paying attention to Big Blue again.
Yeah, there you go. I was going to say, it's not as talked about as NVIDIA, but kind of some sneaky things to follow along there with Big Blue. Well, coming up, we have even more committee moves to tell you about, so you want to stick around. But first, a look at the state of retail. The trades on Home Depot, Lowe's, Target, and more. Halftime is back. Just 2 minutes. Dow down about 250 points. Welcome back. Shares of Home Depot, Dow component, lower despite beating earnings. The company raised its full-year outlook, but expects comp sales to fall 2.5%. Steph, you own it. Still negative comp sales 8 quarters in a row, but it's getting better. It was the best comp sales result we've seen in about 7 quarters, I think.
It's a long time coming.
Yeah, it is.
So, and this is before interest rates will help them.
Yeah.
So they're doing all they can, Court. You know this, right?
Yep.
Just to deliver and actually beat expectations. The whisper for comps was 2.5%. and they came in at 1.5, negative 1.5%. So certainly a little bit better. Hurricanes actually helped them, and the weather also helped them, but they are doing a really good job in terms of margins, in terms of gaining share in the pro market with the SRS acquisition. And I thought that it was really interesting that sales have actually outpaced inventories for the last 6 quarters in a row. That's a very healthy sign, as you know. So they're going to have pricing power. They're going to get demand when rates come down. And I'm still a big fan of housing for the next decade, just given the supply demand dynamics.
Yeah, I spoke with CFO Richard McPhail ahead of the call, and he was sort of saying, look, we think it's only a matter of time for our homeowners to stop deferring these big projects. They're waiting on interest rates. We need that to stabilize. That's what Ted Decker said on the call. When they thought interest rates were coming down, they didn't. In some cases went higher, and so they're just reluctant to make those big purchases. But he said they're not trading down. It's not like they're doing the project at a lower price point. They're just waiting in total.
They were huge beneficiaries during COVID, right? But how many dishwashers do you need?
True, right?
How many
the replacement
TVs
cycle.
do you need?
Yeah.
It's a cycle thing. So they're going to come out of it. This was very encouraging. On a 5-year stack, they had the highest ticket acceleration since the second quarter of 2023. So there's some good things underneath the surface. We just need rates to go in their favor.
Rob, you own this one. What did you think about this quarter? Would you make any moves based on it?
Despite some of the things that happened that were idiosyncratic to this quarter, like the weather, I think you have to say that the worst is likely behind both Home Depot and Lowe's. Home Depot, moved to the professional, the professional customer versus the DIY, and that pressured margins a little bit as well. But when you look at the way the stock has acted since reporting and the prospect for lower interest rates, again, we will see if it actually travels the path that markets expect. But if you get that, there's huge optionality in these names, yet they're small positions for us.
Okay. We're going to stick with retail for a second here because we've got some new numbers actually showing the U.S. consumer is holding strong. So let's get to senior economics reporter Steve Leisman. He's got more on that with some proprietary data. Hey, Steve.
Hey, good afternoon, Courtney. The CNBC National Retail Federation Retail Monitor using actual credit card data from Affinity Solutions shows consumers bouncing back in October after a disappointing September, with Americans maybe seeing a little extra money in their pockets from declining gas prices. Take a look. The Retail Monitor, again, actual spending data from Affinity. This is our top line data, takes out auto and gas up 0.7 after a 0.3% decline in September, year on year 4.1. And then we take out restaurants to do you can't see this if I don't walk right, a core retail number up 0.8% again after a 0.3% decline. A note, the census reported a pretty strong number in September, a solid gain, with a disparity maybe related to seasonal adjustments and the tricky timing of Labor Day. For October, though, sporting goods and hobbies doing quite well. Non-store retailers, that's digital sales, really. Building and garden supplies, hey, maybe Home Depot in there. Healthcare, so I say homes, hobbies, and health all did well. What didn't do well, clothing and accessories. I'm going to ask Courtney about this in just a second, because that could have been weather related. We were around 5 degrees warmer than normal in October, so maybe retailers got caught with a little bit of extra winter and cold weather wear. The Affinity data shows spending on gas has fallen 3 months in a row, and then 12 of the past 14 months. The Retail Monitor bouncing around a little bit when it comes to the census data, but overall plus or minus absolute error of about 0.3% compared with the government data. Now, remains to be seen how much hurricanes in October affected the spending data, especially in Florida. The Street looking for the government to report a modest 0.3% gain in retail on Friday. So, Courtney, maybe some warm weather affecting those apparel sales.
Yeah, I think absolutely that is the case. I mean, Home Depot talked about warm weather. Of course, they don't sell clothing, but to your point, right? I mean, how excited are you to buy a winter coat when it's 80 degrees on Halloween and your kids are outside trick-or-treating?
No raincoats either, because we had the drought throughout the country, so no umbrellas and no raincoats. But I don't know, Courtney, if you're as excited as I am for the November data. We start to get into seeing how the holiday season is going.
Yeah, I absolutely am, Steve. And if I can grab you before we let you go here, I thought it was interesting in the press release, the quote from Matt Shea talks about prices actually falling in some categories. And this, of course, comes ahead of CPI. And it just seems to me that so many Americans are so price sensitive. Perhaps we saw that play out when many went to the polls on Election Day. I'm just curious what you think we'll see tomorrow in CPI based on potentially what you've seen in some of the patterns of this data?
Well, we've been a little stuck. We haven't had quite the deceleration that we had in other months in the past couple. So we'll see if it continues tomorrow. We're looking for 0.2s pretty much across the board on the CPI. And you're right. Tom Barkin, the Richmond Fed president, in a speech this morning, said that he thinks consumers more price sensitive. And the other important part of that is price sensitivity teaches businesses how far, what their limits are in terms of raising prices. So I've seen, for example, when I went to, Stop and Shop the other day, there was a sign that said, we've lowered, and then it had dozens crossed out, hundreds crossed out, then the words thousands of prices. So it's interesting. Companies are not only learning the limit to which they can raise prices, but also, I think, feeling that sensitivity from the consumer and actually lowering prices where they can in certain places.
Yeah, and giving some of that messaging right back to them, seeing if we can get them to react. Steve, thanks so much. Great stuff, as always. Thank you very much, Julia. Well, coming up, one big industrial stock hitting all-time highs on activist activity, plus Stephanie Link making some more big moves in that sector of the trades, coming up next on Halftime. Welcome back to Halftime. We'll check out shares of Honeywell hitting a new record high today. Activist investor Elliott Management taking a massive stake in the company and pushing for a breakup. Sticking with the industrial, Steph, you are making some moves in the space. You just bought Rockwell Automation, I believe, for the first time in forever, as my kids would sing from Frozen.
Like ever.
Like ever.
I've never owned it, but I like the reshoring theme. We've talked about the names that I own. Quanta Services, GE, Vernova, Eaton, but they're all up about 55% year to date. This one is also on the same theme, but it's down 10% on the year. It's down 19% since 2022. It's done nothing. And they have best-in-class assets. They have a new CFO from Graco, and when he was at Graco in 2011 until he just recently joined this company, the stock was up 633%. So I know it's not just the CFO, it's obviously the CEO and the bench, but he's a very strong candidate. He's very strong in terms of margins, new product initiatives, etc. They've got a huge cost-cutting program as well, new product, innovation. And so I like that theme, and I'm just trying to find some laggards in the reshoring theme because I think it's a $10 trillion total addressable market over the next 25 years.
Speaking of a laggard, probably not reshoring, but Boeing.
And how? It has definitely been a laggard. It's been very disappointing this year, but I think they're starting to turn the corner. They just raised $21 billion in cash, so their balance sheet is okay for the next 3 years, gives them breathing room. They fixed the strike situation, which I think is very positive. And then there's some speculation that they're going to sell their navigation business and other non-core assets. The navigation business could go as much as $6 billion. And so this new CEO, it takes up some time to get your footing. And so I think he's got a great track record. I think you're going to see more asset sales. I think this is a 2025 story, so I don't think I'm going to make a lot of money between now and the end of the year, but I do like the name for the long term in a duopoly. It's not a demand problem. It's been a company-specific problem.
Sure. Bryn, you're not in the space at all. You don't see opportunity here like Stephanie does.
I mean, Steph is up for a challenge. And so I think she's got this. With Boeing, I just think, they can't even get their Starliner right. I think it's just such a troubled company that, we have astronauts in space now that SpaceX, their competitor, has to go get. And so obviously Steph does great work. I just think some companies are just in the too hard camp. And to me, it feels like this company is just like a bureaucratic mess. And when you have a duopoly, how can they get it this wrong? And so I just think this has been such a troubled company that needs a massive rehaul. And maybe, to her point, maybe the new CEO can come in and do that. But it just seems to be something that's more structural, but not just at the C-suite level. But I hope I'm wrong and it does really well in 2025.
Bill, you're not involved in Boeing. You do have some industrials, but you're trimming. Why?
We've been trimming over the last over the last 2 weeks ago. Ahead of a lot of the earnings from industrials. Wabtec, WAB is one of our was in our top 5. So when I talked about Microsoft and adding to that, it's a little bit of rotation we've been doing, trimming some of the industrials. They're up over 50% year to date. I mean, how much more can you ask for from an industrial name? Another one is United Rentals. We still really love them. They're right around between 10 and 15 rank out of 35 names. And URI, also up more than 50% year to date, is in our concentrated portfolio where we own no more than 10 names. So we like a lot of these. I think they have these niche businesses that can lean on infrastructure spending, specifically in URI's case. MasTech is another one. It's up about 80% year to date. We haven't trimmed that one, but we're just kind of letting it run. It's breaking out, and I think there's there's a lot of targets on the street that say that can hit 170, 180.
Well, straight ahead, Mike Santoli has his midday word. Halftime, we'll be right back. Welcome back. Time now for our calls of the day. Snowflake added to the best in breed list at D.A. Davidson. Stephanie, you own this one.
I do. It's been kind of a bad one, down 37% year to date. But I do still think that these guys are the best at what they do in terms of providing data, clean data for AI. AI is only as good as the data. It's a total addressable market of $290 billion. These guys have the leading share. I think you're in the early innings overall, and I think the company now, you're going to have 2 quarters now under the new CEO, and usually it takes about 2 or 3 quarters to get a new CEO to understand how to work Wall Street and work the magic within the company as well. And so it's not cheap, but it's certainly, the multiple has come down substantially, and I just think that this is one way to play AI that might be off the radar screen for a lot of other people.
Bryn, you do not think this one is best in breed?
Well, no, I think that the stock has not been best in breed. And so it's a curious name because it's like the market does not like this name, but they have great product, lots of adoption, but it's still, the market is just saying down 35-40%. We don't like this name. And so I'll be curious over the next few quarters if they can just pivot on that, because you would think that they would be getting more adoption from a company perspective, but just dollars aren't flowing there. So I think, hopefully next year doesn't look like this year, and they can finally gain some traction with the new CEO.
And we're moving on real quick here to Wells Fargo, added to the U.S. 1 list at Bank of America. Rob, you on this one?
I do. We prefer, as I talked about yesterday, some other financials relative to this right now. This has been a long-term holding for us. They did a reasonably good job in their most recent earnings report. They beat on the bottom line. They managed expenses well. The investment banking revenues did well. When you look at non-performing loans, they held steady. So I think this is an interesting name, but we are looking at names like Jefferies and names like Comerica as names where you can get a little more price performance, because the financial sector is getting expensive right now.
And then one more real quick here. Salesforce target raised to 330 from 275. This one at Wells Fargo. This is a new record high here. And Rob, you own Salesforce.
Bought it over the summer. This is emerging as one of the leaders in the monetization of AI. One of the most influential software companies in the world, one where you're starting to see forward earnings get adjusted higher. I think that's part of the problem with some of the names that are the big ones that have been winners, is forward earnings are coming down, expectations are coming down a little bit. So you want to see those accelerating, and Salesforce is one of those with great fundamentals.
So they raised the target to 330, but right now shares are trading at 343. Well, stay with us. Final trades coming up on halftime. We're back on halftime with final trades. Bryn, we'll start with you.
Yeah, RSP, S&P equal weight. While it's equal weight by stock, it's not equal weight by sector. Financial and industrial are the top 2 holdings.
Rob, you're up.
I'm going to go with the same pick from yesterday, CRM, and we've talked about it today. I'll cede my time.
Really believe in that one, Bill?
Microsoft, I expect it to outperform the NASDAQ between now and the end of the year.
And Stephanie, bring us home.
Target, very low expectations, value proposition, getting people in the stores, 10,000 SKU cuts, price cuts, that's good. I expect a solid quarter.
Going to be some interesting moves for retail in the coming week or so. That does it for halftime. The exchange starts right now.